Good afternoon, everyone. I'm Lisa Patel, and I'm your president. Thank you for joining us for TRREB's Commercial Development Forum. And today's TRREB's Chief Market Analyst, Jason Mercer, and Altus Group's VP, Ray Wong, will break down the commercial market numbers for you and give you a glimpse into new workplace trends. You asked and we'll answer. Stick around for the Q&A and hear from Jason and Ray have to say on the disruptive year for the commercial market and how it's trickling into the new year. Now on to our first speaker of the day. I'd like to introduce the Toronto Region Board of Trade President and CEO, Jan De Silva, to talk about moving the region's economy forward. We're thrilled you could join us today, and welcome, Jan.
Hello, everyone, and thank you, Lisa, for that introduction and for inviting me to TRREB's Commercial Development Forum. This is such a timely moment for these discussions. As people who help business owners build and find the perfect location, the pandemic has certainly raised questions about the future of commercial spaces. What does commercial real estate look like when work from home and shop from home has become the new normal of this past year? Well, I'm happy to join you today to share what we're hearing and working on, and let me tell you, it will be encouraging news for you. Like TRREB, we've been actively engaged with our more than 13,000 members and partners since the pandemic began. In the earlier days, it was to understand how COVID was impacting our businesses and what could be done to help them ride out the crisis. But as days and weeks turn into months and now enters its second year, we've turned our attention to mitigations to reopen our economy more fully, safely, and sustainably, with COVID expected to remain a continuing condition for the coming 12 months. What we are seeing is a very clear transition in thinking. Where 6 to 9 months ago, the view was work from home, well, it was working just fine. And many professional services firms in particular were rethinking their commercial footprints. Current thinking has shifted. Yes, remote tools kept economic activity going, but onboarding and engaging employees is proving difficult in our virtual world. Days of back-to-back Zoom meetings are more transactional and less engaging. Employees are missing a more personal connection to their organizations and their colleagues. Earlier this month, we engaged Analyst research to poll downtown Toronto workers. Nearly 7 out of 10 people said they'd go back to the office tomorrow if they could, missing in-person collaboration and relationship building. And we want them to return. Pre-pandemic, downtown Toronto attracted more than 550,000 daytime workers who were the customers of thousands of smaller downtown businesses. And speaking of missing customers, pre-pandemic, Toronto's visitor economy attracted 28 million people to the city in 2019. Since October, we've had efforts underway in the Financial District, an initiative we're co-chairing with Mayor Tory, Urban Land Institute, and the Financial District BIA. We've convened building owners, large employers, solution providers, and public health advisors. Our focus is to deploy mitigations to support the safe, sustainable, broader reopening of the business district when the time is right. Our mitigation are focused on 4 key areas: a safe district, which covers rapid testing, exposure notification, and vaccinations; safe buildings, which addresses ventilation and air quality improvements; safe workplaces, which is all about congestion management in the workplace. There are some challenges around coffee stations, believe it or not; and safe travel, building confidence in public transit. We've looked globally and locally to address these themes, and we've vetted them with our public health experts. We'll be releasing a mitigation toolkit shortly and are working with building owners and major employers to activate a Ready for You communications campaign with a goal to build public awareness of what we've done to get ready for you, get ready for reopening. And the Financial District is one of 3 pilot zones we've activated. The others are the Pearson Airport and Logistics Zone and Scarborough Center. Different types of business districts where we are identifying similarities and differences in what they need for their reopening efforts or quite frankly, in the case of Pearson, to support the broader and more complete reopening of the many essential businesses that have been operating throughout the pandemic. As public health focuses on beating the health crisis, we're doing what we're capable of, convening business and government to be ready to reopen as soon as it's safe to do so. TRREB, thank you for being such a strong, long-term, influential partner of the board. We know you share these objectives to restore confidence and support the conditions for reopening our workplaces and our economy. To access more information or to consider getting further involved, contact us at bot.com/getready. Lisa, thank you again for the opportunity to join the forum today. Have a very successful forum. Let's talk soon. Thank you.
Thank you, Jan. We appreciate your perspectives on the road to economic recovery. Our next speaker is TRREB's Chief Market Analyst, Jason Mercer, providing us with an update on the economy, employment, and the commercial market. Over to you, Jason.
Well, thanks very much, Lisa, and hello to everyone that's taking part in today's webinar. It's been a few months since we did our last commercial development forum along with Ray Wong from Altus. I believe it was back in October. So obviously a lot's unfolded since then, and so we want to go through, number one, the underlying economic drivers of commercial real estate in the Greater Toronto Area and even beyond, and then I will turn it over to Ray to go through some detailed stats on the various segments of the commercial real estate market in the GTA and also Southwestern Ontario. So again, Ray, thanks for joining me. I'll jump right in and then turn it over to you in a few minutes. And so if we move to the first slide, this is just sort of a high-level look. I mean, each year we have Ipsos undertake consumer polling for us in the marketplace at the end of each year. And, certainly if we think about what the key issues that have been top of mind for individuals, and I'd argue businesses as well, over the past year, obviously just coronavirus in general has been a key. But then, thinking about the impact of coronavirus, obviously next on people's mind is the overall economy. A third of people had that as one of their key or most important issues. And obviously, if you think about commercial real estate, it makes a lot of sense because whereas, some sectors of the economy over the last year were able to bounce back fairly quickly from what we went through back in March, April, and May of 2020, but other businesses, have not recovered back to levels that we saw in the pre-COVID era, and that has impacted certain segments of the commercial real estate market more so than others. And so if we move to the next slide, what we see here is just sort of the lens through which we've been really thinking about the overall economy and thinking about the real estate market in Ontario, whether we're talking about, commercial or residential. And so, what this slide shows in blue is just the daily positivity rate for COVID-19 based on the testing that we've been doing across Ontario, and the orange line is just a 7-day moving average to sort of smooth that out a little bit. But what we see is that indeed we've been through at least a couple of waves, and the jury's still out, I'd argue, in terms of whether we will see a third wave or not. And so obviously if we think back to the spring of 2020. And think about, what we went through during that period of time. There was a lot of uncertainty, obviously. So we had a broad-based shutdown, and that included most sectors of the economy. And it took about, a number of weeks to say a month's time for some of those segments of the economy to make that move from the, bricks and mortar office to the home office. And it worked quite well for some of those sectors of the economy. And as we moved into, the late spring and certainly through the summer and fall, we had a period of time where, many other businesses, even person-to-person businesses, were able to open up as the case count declined and the positivity rate declined. But obviously, as we moved through the fall and even more so towards the end of the year, we moved into definitely what can be termed as a second wave in terms of the positivity rate. for COVID-19. And that impacted, again, certain segments of the economy more so than others, especially that bricks and mortar retail, arts and entertainment, accommodation and what have you. And so if we move to the next slide, we can start to sort of think about, how that impacted, how that sort of COVID-19 curve, how that impacted the overall labor market, the overall economy in the Greater Toronto Area. And so this just looks at, in terms of millions of jobs in the Toronto Census metropolitan area, and we can see the drastic impact that initial wave of COVID-19 had on the overall economy, and obviously that filtered through into the demand for different types of commercial real estate. But fortunately, we saw a very strong dip to where we lost basically a decade of job growth. We moved back to where we were in the fall, let's say, of 2010. But then, fortunately, very, very quickly, we rebounded back to levels that we had seen back in 2019. So by the time we moved through the summer, if you looked at the overall economy in the aggregate, we had recouped a lot of those job losses that we had initially seen through the spring. But obviously, as we moved through the fall, again, that second wave came into effect, and we did see, again, a bit of a pullback, especially into some of those businesses that had been able to open up for a short period of time through the summer and fall, sort of person-to-person businesses, restaurants, a greater swath of retail activity as well, and that shut back down as we moved through December and certainly through January and February as well. And so, it's those sort of segments of the economy that we'll be watching, very closely over the next few months. And if we move to the next slide, we can see that there's still a ways to go. If we can look at overall employment, but we can also think about the unemployment rate. And the unemployment rate is important because, if you think about the real estate market, we often think about demand and supply, right? So the demand for real estate and the supply of real estate, and that interrelationship sort of dictates where pricing is going to go. Well, it's not dissimilar if you think about the labor market. If the demand for employees is strong and there's not a lot of people ready to move into those jobs, then the labor market's tight, and you start to see increases in income. Conversely, in times like these, there's a lot more slack in the labor market. So that has implications sort of medium to longer term if you don't see that unemployment rate start to trend lower. Now, fortunately, we certainly came off the peak that was in the mid-teens back in the spring of 2020, but there's still a ways to go. People lost their jobs. Not everyone has made it back to full employment for sure, and some households, haven't made it back to even part-time employment. And so while we've seen, quite an uptick in economic activity from the spring of last year, there still is a ways to go. And over time, if we don't see that slack come out of the labor market, then that could have implications for incomes moving forward. Obviously, the hope is that we continue to see a downward trend after that short blip that we saw, say, from December through February. It's also important to point out that, even though we saw a fairly strong and fairly rapid overall recovery, if we think of jobs in the aggregate or we think of unemployment in the aggregate, again, that recovery has not been uniform across all sectors of the economy. And so if we think about, year-over-year employment change, February 2021, compared to where we were back in the last sort of pre-COVID month of February 2020, less than half of those sectors of the economy have sort of recovered to or above, where we were in February 2020. And it's interesting to note that, these are also the segments of the economy that had, higher average to above average earnings in terms of the average hourly wage over the last 12 months. And that speaks to the type of work that was able to move quite quickly, again, from that bricks and mortar office to the home office. And in a lot of cases, if you look at the bottom axis, we're talking about finance, insurance, and real estate, government, education, professional, scientific, and technological, or jobs that you're able to perform them safely from a social distance. A lot of manufacturing activity, certainly utilities, resource extraction. That's a lot of that work is undertaken outdoors or in areas where you can work at a safe distance. If you look at the other end of the spectrum, those sectors of the economy that have not rebounded and in many cases have not seen their employment move anywhere close to where we were a year ago in February 2020. Obviously, at the top of that list is accommodation, food and beverage, sectors of the economy that require, by and large, or to a large degree, that person-to-person interaction, information, culture, and recreation. Again, activities, thinking about, kids going to play hockey or, indoor soccer or any of that type of activity where that's been by and large shut down or substantially reduced in terms of the number of people that can partake in those types of activity. Well, obviously that impacted employment in those areas as well. Thinking about the commercial real estate market in particular, look at that business services segment. A lot of that is made up of people whose job it is to maintain, say, office and other commercial buildings. And to a great degree, a lot of those services haven't been required, or not as much of those types of services have been required, and that's obviously impacted the labor market in those segments of the economy to a great degree. So if we move to the next slide, then it's important to then think about those sectors, because that's where the slack remains in the labor market, are those sectors that haven't made a full recovery because of the inability to open up for a sustained basis or open up fully in terms of the number of customers that could be served. And obviously the retail sector is a key component of this. And I know Ray in his presentation will discuss retail in more detail. But the blue line on this chart just shows overall Canadian retail sales. And if we just looked at that line on its own, we'd say, wow, that looks a lot like the overall employment trend that we've seen. And that's because we have, after a real sharp dip in overall retail sales, we rebounded quite quickly to the point where we actually saw retail sales above where we were this time last year. But the issue is the components of those retail sales or where they're coming from. And so that's where the orange bars on this chart come in, because we're looking at the share of those transactions that have sort of shifted away from the bricks and mortar environment and into the realm of e-commerce. And so, it is important to note and that, we're seeing a share of e-commerce sales overall over the last few years start to trend upwards. But obviously we saw a big spike back in the spring. And if we think about where we are where we were at the end of 2020 in terms of share of e-commerce sales compared to the same months back at the end of 2019, obviously a substantial increase in terms of the share of e-commerce transactions. And so while, on the aggregate, we've seen retail sales recover, it's where those sales are taking place and obviously how that has impacted employment in that sector of the economy. And so if we move to the next slide, it is important to point out that, for the first time since we started looking at this chart, which is produced by Indeed, this is the first time over the last few weeks that we've actually seen, job postings. So postings for new jobs that are available to Canadians today. It's the first time over the last couple of weeks that we actually saw total job postings start to creep above where we were in the pre-COVID period. And so again, that's an important, and positive leading indicator when we're thinking about where the economy is going to go. And I mean, I think a lot of that relates to the fact that, even sectors of the economy that are still experiencing a slowdown right now, they see the light at the end of the tunnel. And they're thinking about starting to staff up in order to meet the increased demand that we expect to see for goods and services as we move through 2021, and even more so as we move into 2022. It's important to point out that a key driver to see the rest of those jobs, the jobs in those sectors that haven't fully recovered from that initial COVID-19 downturn, a key indicator will obviously be the uptake of vaccine. And so, we've been off to a bit of a slow start in Ontario and across the country in terms of vaccinations vis-a-vis other developed countries around the world. But we are headed in the right direction. We are seeing a growing number of adults being vaccinated, and by all accounts, the news is positive in terms of more and more doses arriving in Canada on a weekly basis of different types. So I'd expect the next time that we talk in a few months about the commercial market, when we update this slide, we'll see a steeper upward trend in terms of the number of adults that have been fully vaccinated, and obviously the overall share of the population, which is the orange bar on this chart, increasing as well. But I do believe that by and large, businesses and the population in general are more upbeat than certainly, say, before the new year in terms of the ability to get the population vaccinated in totality as we move through 2021. And that's obviously good for business confidence. It's good for investment in businesses, including in real estate, as we look forward to the end of this year and into the next year as well. And so if we move to the next slide, it's important to sort of think about, well, what's going to drive the demand for goods and services across all sectors of the economy once we get to the other side of COVID-19, once we see widespread vaccination, both globally as well as in Canada. And a key thing that's been missing, a key driver of overall economic activity that's been missing over the past year is population growth. And that's really important. I mean, we often talk about population growth. I often talk about population growth in conjunction with the housing market. But it's just as important when you're thinking about overall growth in the economy, because you need to see an increase in households in order to see an increase in consumer spending. And consumer spending in Canada accounts for more than 2/3 of overall economic activity. And so, looking forward, once we see that widespread vaccine uptake, a huge component of the federal government's overall recovery plan is to see an increase in immigration to levels that we haven't seen in many decades. And so as we start to see a resumption in population growth, both from immigration and, if we move to the next slide, from non-permanent migrants as well, because that's an important component of the overall economy and overall population growth in the Greater Toronto Area as well. Because not only do we see overall population growth and demand for all goods and services increase, but we also see increased demand for, say, multi-residential properties, which I know Ray will touch on in his presentation as well. That's been a major driver for the demand for rental accommodation in the Greater Toronto Area and beyond over the last few years, because here we're talking about students and we're talking about individuals that are moving to the GTA on a temporary basis to take on one form of employment or another. And obviously we moved from, on net between 2016 and 2019, I've seen, somewhere between, say, 60 and close to 100,000 net non-permanent migrants moving into the Toronto area, the GTA, on an annual basis, to seeing, a decline in non-permanent migrants to the tune of 40,000. So that's a big turn over the course of the year, and I think factors a lot into temporarily what we've seen in the multi-residential market, where we have seen an uptick in vacancy rates, and obviously that's impacted the ability to bring on rent increases and what have you from landlords. And so if we move to the next slide, sort of just thinking about, well, what do equity markets think about the prospects for growth moving forward? Because when you look at an indicator, here we have the S&P TSX Composite Index, that's giving us a sense for what equity traders think today about growth tomorrow, about growth, say, a year down the road. And so when I see that, the S&P TSX Composite has moved above the levels that we are at, in the immediate sort of pre-COVID period, that indicates to me that, people are buying into the fact that we are going to see continued growth as we move through this year and even more so into 2022. And the next slide, when we think about equity markets in the United States, that growth has even been more pronounced. And so the notion south of the border, Canada's largest trading partner, especially when you're thinking about the industrial sector of the economy, the notion that we're going to see very strong growth continue as we move through the second half of 2021 and even more so next year bodes very well for the industrial sector in Canada. And I'm sure Ray will have a lot to say about industrial, both in terms of traditional industrial, but also how some of that industrial space has become more and more tied to overall retail activity when we think about e-commerce and what have you as well. If we move to the next slide and think about overall growth in the Canadian economy, obviously we saw a very high volatility from the second quarter of 2020 through the third quarter, as we saw an immediate decline in sort of March, April, and May, as we were initially coming to terms with COVID-19 and the uncertainty around which public health measures would work and which wouldn't, and as businesses made that transition from the bricks and mortar office to the home office. But again, by and large, we were quite successful. And so we saw a fairly strong rebound again as we moved through the third quarter and fourth quarters of 2020, to the point where the consensus forecast for overall economic growth as you move through 2021 is sitting at around 5%. And so, that's not as large as those numbers that we saw in the third and fourth quarter of last year. But if we look at those orange bars in comparison to the type of growth we've seen over the last, say, decade to decade and a half, it's relatively strong. Because, over the last few years leading up to COVID, the norm for GDP growth had been sort of in that 1% to 3% range. So seeing 5% growth on average as we move through this year and into 2022 is still indicative of pretty substantial growth, and will have to include, a rebound in some of those sectors of the economy that have been, slower to improve. And again, that suggests that forecasters are buying into the notion that we are going to see that widespread vaccine uptake, and that will positively impact those person-to-person businesses, whether we're talking about tourism, accommodation, food and beverage, or bricks and mortar retail. And so if we move to the next slide, it's important to think about, well, what will this all mean? If we continue to see an uptick in consumer spending, if we continue to see, above average growth in the economy, well, how's that going to unfold? Well, number one, because people haven't been spending as much, especially on sort of entertainment, on travel and what have you over the past year, Canadian households by and large have been saving, and they've been saving to a great degree. And this chart just bears that out when you look at the spike in the Canadian household savings rate. And you have to go back to the 1970s when inflation was running super high as a result of spiking oil prices, and people weren't spending money because interest rates were also spiking in order to get a handle on inflation. Different scenario this time around, because we're actually moving through a period of very low interest rates, and the Bank of Canada has actually signaled that their policy rate, their target for the overnight lending rate, is going to remain at 0.25% over the next couple of years. And so as people start to move from purchasing online and getting out of their house and perhaps traveling, going out to restaurants, going out to shows again, you're going to see a real willingness to do so, because number one, the labor market has been strong, and number two, they're going to be able to take advantage of low borrowing costs as well. There is an implication though, because with increased spending also comes inflation. So here we're looking at the year-over-year growth in the consumer price index, a couple different measures. The blue line is just looking at all the consumer items that Statistics Canada focuses on when they're looking at inflation. And then the orange line, which the Bank of Canada uses because it strips out a little bit of the volatility that we see from some segments of the economy, like gasoline and food purchases that tend to be more volatile year in and year out. But by and large, since the spring and summer of last year, we have started to see, in inflation by either measure start to move back to that sort of 2% target, the Bank of Canada's sort of long-term target for inflation. There's certainly still a ways to go, but that's certainly an indicator that we'll be looking at when we think about interest rates, both shorter-term interest rates and longer-term rates, and will certainly be a key driver of the Bank of Canada's decision around their target for the overnight lending rate over the next couple of years. And if we move to the next slide, We can talk a little bit more about interest rates, and this is actually where I'll leave off and kick it over to Ray. But we can just see, if we look at the blue line, I mean, that was the very strong reaction that the Bank of Canada had to COVID-19 back in the spring of 2020, and we could see basically overnight. We saw their target for the overnight lending rate drop to levels that we hadn't seen since the recession in 2008 and 2009, a quarter of a percentage point. And the Bank of Canada has all but signaled that they intend to keep the target for the overnight lending rate there, certainly through 2021 and quite possibly through much of 2022 as well. So it's interesting then when we look at, say, the 5-year Government of Canada bond, sort of a midterm interest rate indicator, and also the longer term 10-year Government of Canada bond, more indicative of longer term investments, that we've actually seen yields creep up quite a bit over the last few months. And that's because bond traders, participants in the fixed income markets, are thinking about, well, what are we going to see on average over the next 5 years? Or what are we going to see on average even longer over the next 10 years? And, obviously they feel that we are going to see a further rebound in the economy. We are going to start to see some of those savings that have built up in people's bank account. That's going to start to be spent in various sectors of the economy, and that's going to lead to price inflation. So over the medium to longer term, certainly the expectation is that the Bank of Canada will start to raise their overnight lending rate, and over time, we'll start to see it, average out closer to where, say, yields on the 5 and 10-year bond are right now. But that's also important when we're thinking about real estate valuations too, because the starting point often when we're thinking about, investment in real estate and returns in real estate, thinking about things like cap rates and what have you, often the starting point is what we expect to see in terms of yields on longer term government bonds, including the 5 and 10 year that we're looking at here. So I think with that, I'll turn it over to Ray, and he can sort of take it away from this sort of broad discussion of economic indicators and drill into different segments of the commercial real estate market. And certainly I'll stick around to answer questions at the end of the presentation. Thanks very much, and over to you, Ray.
Thank you, Jason. I'm glad to be part of another commercial development forum hosted by TRREB. So as we go through the presentation, we're going to highlight some of the indicators of several green shoots that Jason already covered in his presentation. So it's last time we used this term was back in 2008 and 2009 when we were looking to come out of the financial crisis. So some of the elements Jason mentioned with respect to the market, the vaccine rollout, capital market activities picking up, employment growth is coming back, rising house prices, and return to normalcy to a certain extent with immigration. But again, this is going to be based on timing of the vaccine and when people feel a little bit safe again. But let's also take a cautious tone to the next 6 to 9 months and potential bumps in the road, such as the discussion right now, the possible hit of another third wave, the dangers of hyperinflation, and again, all the savings that has been accumulated in the last number of months, interest rates, and it's, even though the bank has said that it's going to be relatively flat for the next 1 or 2 years, it'll be interesting to see the impact on the interest rates and an ongoing discussion of impact on the office. But look for more partnerships between tenants and owners this year, and especially with respect to safety protocols, wellness initiative. Again, trying to get people back into the office or back into the retail, back into the stores. And as Jason mentioned, with regards to the biggest employment hits, has been in the hospitality sector. So hopefully we'll see that improve over the next little while. Let's begin with the capital market. So when Jason was talking about the interest rates remaining flat, part of the concern that we've been having, and this is our investment trend survey that Altus produces on a quarterly basis, and this looks at the overall cap rates. When you look at overall cap rates, it's predictable. Multi-res continues to do well as the demand for industrial. So that's heading downwards or in anticipation. And our first quarter numbers, the initial results are indicating that trend. Where we have a little bit of uncertainty, especially on the office sector and the retail sector, that's where we're seeing anticipated increases in cap rates. But based on the low interest rates, it'd be interesting to see what type of changes. I don't think we're going to see cap rates change direction on the most active product for apartment industrial, but we will see some potential opportunities and potential upward movement in cap rates, especially in retail and perhaps tertiary markets. And again, it remains to be seen on the office sector. And this is the overall investment activity on a national basis. Overall, we're down about 21%. Considering what we went through in 2020, it's not bad. When you look at that time frame of 2008, 2009 with the financial crisis, overall investment activity was down 40%. So we're starting to see, especially in the second half of 2020, increase in the number of transactions happening in the marketplace. And again, that's also the result of the availability of capital that's coming back to the marketplace, as well as confidence from investors, also looking for opportunities, especially from the private investors that we have seen them quite active. So again, we're anticipating definitely more activity compared in 2021 compared to 2020, but the challenge, and probably everyone on this webinar is finding is a challenge to find on certain products, especially on the industrial and multi-residential side, and keeping in line with price expectations. And then when you look at this is our initial numbers, and this is part of the green shoots that we're seeing, especially with Toronto. So overall investment volume is up by 9%. The number of transactions are down, but it shows you that the larger transactions are starting to happen. Again, this is a result of deals that happened back in fourth quarter, but this is the result in first quarter with the number of transactions closing. So compared to 2020, that we're in Toronto, at least we're up, but the number of transactions are up in Montreal. Vancouver, that's because of the delay of the data. The numbers are not down by that much. That what we're seeing is delay of the information from BC assessment. So those numbers should be nearer as we get into the final numbers of first quarter. So again, certain positive aspects with regards to confidence back in the marketplace. And you look at the overall GTA transactions for 2019 versus 2020. Again, GTA is down by almost 23%, 22.7 billion to 17.5 billion. Industrial, the volume is actually up by 5.1%. So the number in the white in the charts is the number of transactions. So industrial, actually in 2019, there was 518 transactions. In 2020, there was 511 transactions. So again, it bodes well for the industrial sector and what Jason mentioned earlier, but with that growth in e-commerce and that continued demand for space. Apartment remains very sought after, but again, because of the shortage in an investment product, that overall volume activity is down by 37%. And office is down the largest by 61%. And retail has also received a lot of that sort of that negative media and discussions, only down by 17%. And that's a result of private investors that are looking for opportunity. So anything that can be redeveloped, can be expanded, and that can have an upside in potential income. is actually being sought after, and retail is an indicator that despite what's happening in the retail sector, it's only down by 70%, which is quite good. We looked at one of the pandemic influences, and again, this has showed up with the demand for food anchor grocery retail strips. Again, demand is high from the investors. Again, this is our investment trend survey. So one of the most sought after products. That the challenge is just finding the available product, and the typical story with strong demand on the multi-residential side as well as industrial, especially for industrial land and based on the scarcity in that area. So again, some of the positives and some of the impacts that we've seen on the investment side, start shifting the market a little bit. The next slide, we're going to turn over to the office. And there's been a lot of discussion that this whole work from home thing is actually working out quite well. For companies, it's the same objectives that remain. They need to be profitable, the traction and retention of talent. They need innovation, operational efficiencies. And again, work from home has done well, but we're starting to see compared to a year ago, and you see this with a number of the different surveys out there, the level of high productivity that we saw a year ago is starting to come off a little bit because people sort of need that interaction, and the office must evolve to address the balance between the needs of the employers and the employees and foster collaboration and reinforce company culture. And the office is basically the main connection point. So I think we're going to see some of that. And what this chart indicates is that when we surveyed our clients, only 62% expect an average downsize of less than 20%. Again, this is very different from a year ago when the work from home took place and productivity was hitting record efficiencies, that there's more stipulation of a drop of anywhere from 50 to 70% of the existing space. So there's a little bit more temperament in the marketplace with companies considering how much space they need, and they may not need that amount of downsizing. But we also believe that even though office space is getting smaller, that there will probably be less people in the office having more of a hybrid model of working from home and working from the office combination. The average footprint will probably shrink, but the average square foot per employee will probably increase to allow for social distancing and other sort of protocols that are needed in the office. When you look at the overall availability rate, again, it's not just, it's a national phenomenon based on the increase in availability rates, especially for the larger markets. And with Edmonton and Calgary, the office availability rates were high before because of some of the challenges in the economy, but with the energy sector. And with the downtown office availability in Calgary, it's up over 30%. And we're seeing less so increases in availability rate with respect to Ottawa and Montreal, but you are seeing increase in sublet space in those markets as well, is where we break down the increase in availability rates. And again, look at Vancouver from 23.3% up to 32.1% in the fourth quarter. Same thing with Toronto, 14.1 up to 24.3, and it's really pushing up the availability rates. And the other markets, it's still you're at double digits, but not to the record levels that we've seen in Toronto and Vancouver. And one of the things that we're sort of concerned about is the amount of new supply. So when you look at the next slide, this shows you the number of office projects under construction. And there's still close to about 20 million square feet of office construction occurring across Canada, most of it in Toronto and Vancouver. And most of that space is still leased up. And that's sort of the most sought after space still because of of the newer technology based on the HVAC system, the wellness protocols that were put in place before the pandemic, allowing for better air circulation and as well as more sort of distancing with respect to the office space and the employees. And this is where we're going to see probably a bit of a shift in a little bit more challenging with the Class B and C space, being able to retain tenants, especially if availability rates move up. And again, we're shifting in most markets to more of a tenants market rather than landlords, especially with the increase in sublet space. And this is the GTA office leasing activity, and it's not a big surprise in 2020 compared to 2019, a drop of from 7.2 million square feet of lease activity down to 4.2%. But a large portion of that drop, because a lot of the new buildings have saw quite a bit of pre-lease activity back in 2019. It was a drop off of 2 million square feet in 2019 down to 500,000 square feet in 2020. When you look at the actual breakdown for the office leasing sector for the major activity, and this sort of, it almost mirrors what Jason put up with employment growth. So financial and tech still dominate lease activity in the GTA. And again, some of the big drop off is especially with respect to co-working space, manufacturing, but we're seeing some of the shifts in this area. So there is still good news is that there's still some lease activity happening in the marketplace, but some of this activity has been sort of the blend and extend, where tenants have extended their leases, but also reduced some of their space requirements. So we anticipate a little bit better activity in 2021. But probably not a return to normalcy until 2022, 2023, when companies are a little bit more, basically have their workplace strategy more sort of planned out and strategized, and how they're going to interact with their employees and how they're going to interact with each other, and as well as the placement of the office space. Of the office premises. When you look at the next slide, which looks at our overall forecast, and the overall availability rate partially is based on the increase in availability rate that we still have projected for 2021, but it's also a large part is still due to the anticipated increase in sublet space, but also the completion of some of the office buildings in the downtown, pushing the availability rate up. And again, we probably will see a little bit more challenge with the B and C space that don't have the more updated HVAC system and the type of amenities that tenants are looking for, employees are looking for to come back into the office. But what we have seen by the owners over the past 12 months is a big investment into the existing premises to address the safety protocols, and as well as to look at the amenities that are required. And this looks at the overall movement across the GTA, so downtown versus the suburbs. And that's where you see the big increase of 4.2% up to about 11.3% in the downtown. But you're also seeing some increase in availability rates in the Northwest and East. So that earlier discussion point was movement from the downtown into the suburbs is not really happening. That we're seeing some of the firms have moved to be closer to their employees, but we are still seeing some increase in availability rates, but not at the same rate as the downtown, but still as an impact. When you look at the cost standpoint, and the downtown is still almost double in some cases, especially for the AAA, compared to the suburban marketplace. So again, what we have seen is an increase in tenant inducements with 12 months of free rent, build out of space, and we're starting to see some adjustments with respect to the B and C space on the posted rents, but definitely the net effective rents have decreased for the A and B space. When you look at this is our key assumption survey that we conducted in November. So we look at our clients, they're anticipating decreases in rental rates right across the board from downtown to the suburban marketplaces. And again, anticipation that we'll probably see a decrease in the NERs, and it'll be interesting to see the impact of the posted rents, whether how far that they drop this year, or whether or not they will, based on the tenant inducements that we're seeing in the marketplace. So turning over to the retail side, we see a constant change. So similar to a sandcastle, that the waves come in, and it's like every year we constantly talk about evolution changes to retail. And 2020 to 2021 is going to be no different with respect to will retail survive. And our standpoint is retail will survive, especially the brick and mortar, but again, in a slightly different form as it goes through every year. And this is similar. This is what exactly what Jason showed, with the increase in e-commerce and the increase in sales. And again, we see post-pandemic that probably the trend of e-commerce as a percentage of overall retail spending will continue to go up, but probably not at the same pace compared to 2019 versus 2020. When you look at the rental rates, which is the next slide, again, that there is anticipation on continued challenges and the decrease in anticipated rents in the tier 1 malls, as well as the malls retail right across the board, and less so regards to grocery, food, anchor strip, where they've done quite well this year. And again, it goes back to the whole e-commerce part. And if you look at the potential impact, which is the next slide, that we already have demand for e-commerce going one way from e-commerce to the consumers and into the stores. What's coming up is the reverse logistics, that the number of returns. So you're dealing with daily returns of 2 to 9%. Adds to the overall operating cost to the warehouse. And at least 20 to 40% of the items purchased, especially online, are returned. It's less so when purchased in the store. So eventually, we're going to probably starting to see this in the U.S. Dedicated warehouses to just deal with returns, the reverse logistics. So in addition to the growth demand with the Amazons and other sort of e-commerce warehouse distribution, with one direction, you're also going to see pop-up dedicated warehouses, increasing that demand for industrial space with products going in the overall direction. So we anticipate the continued demand increases with respect to the industrial sector. The overall availability rates, again, remains tight right across Canada, especially with Vancouver and Toronto. And part of the issue is the lack of new construction. And a lot of the new construction is still, the majority is design build, very little in way of speculative construction. And this is why you're still seeing low availability rates, as well as increasing rental rates for space. And when we forecast out for GTA, and it's difficult to forecast based on the anticipated new supply. So every year there's anywhere from 10 to about 13 million square feet of new supply. And again, because industrial is a little bit more, it can be completed in about 6 to 9 months, depending on availability and servicing land, that this sort of pops up. So we sort of factor to the 10 to 13 million square feet every year. And again, we're anticipating flat availability rates across the board. The overall activity for leasing side, again, it has dropped off a little bit year over year. With renewals still making up a good portion of the space. And the challenge for tenants is being able to secure space And that's why we're seeing continued renewal activity in that area, as well as the sales activity. Sales activity for the new side is off slightly compared to last year, and that's because a number of the institutions and investors are outbidding some of those areas. But again, industrial activity will remain this year strong this year and going forward as well. And this is the overall availability rate. So again, it's tight right across the board, and the breakdown, and especially with the West, that's where you're seeing still continued activity. But with all the infrastructure spending that we've seen over the past 5 years in the eastern part of the GTA in Durham and Scarborough, that you're seeing a lot more activity, especially with the lower rents. And again, you've seen some of the differences. And this is sort of the gross rent. But when you're looking at the newer buildings, you're looking at almost 18 to about $22 a square foot. So this is an average of the marketplace. But again, it still remains relatively high. And this is, if you have industrial, and this is why with e-commerce, the impact, we went from $49 back in 2000 up to $310 in the initial numbers we received in 2020, and cap rates continue to fall. So again, for asset class, this has done outstandingly well over the years, and we expect that to continue. And we get a lot of questions about Southwestern Ontario, about the 519, and this compares to overall availability rate. So it has had impact on markets a little bit closer to the GTA, with Guelph and Cambridge, a little bit higher in those areas. But again, especially for warehouse distribution, e-commerce, it's all about location. It could be a little bit higher cost with respect to some of the premises, but it has to be closer to the consumers as well as to their customers. So that's why we haven't seen that big shift, even though there's a lot of demand in the GTA into Southwestern Ontario. And you look at the overall rental rates, even though they're about half compared to the GTA, that majority of the activity for industrial still remains in the GTA, just because of the need to stay closer to their clients. And again, when you look at sale prices as well, it's the same trend as the residential. Southwestern, the rental rates with respect to certain discounting cheaper land as well, but the construction costs remain about the same. Okay, so going to the summary slide. So we know that the discussion over the last little while of ESG will continue to impact investment strategies and how companies deploy their investments, especially with the newer product, and staying away from buildings that are less future-proof. So we're going to see a lot more investment into both premises as well as the type of investment going forward. Office needs to evolve and change to meet the needs of employers and employees. So look for a lot more sort of changes and news over the next 6 to 9 months. Right now, there's still a certain element of uncertainty. And e-commerce will continue to impact the future of demand in retail, and the growth for industrial. We just see it continue to grow and continue to be the most sought after. So that's a quick rundown of the commercial real estate sector. And I'd like to now hand it back over to TRREB's president, Lisa Patel, for the Q&A section. Thank you.
Wow, thanks Jason and Ray for breaking down the latest market numbers and your insights on the varying trends in the industrial space versus office and retail space. Now on to the Q&A session. The first question. So this question goes to Ray. Ray, what do you see as the best investment opportunity or product and location for both in the GTA?
What I like is what's happening in the East End, and especially from a price and opportunity standpoint. There's a lot more sort of growth potential, and the pricing is a little bit lower than that compared to the West with Mississauga and Brampton. So we are starting to see a lot more product, and if you look at Amazon alone, they're looking at about 3 to 5 million square feet of expansion. So anytime Amazon goes into a certain location, that you're looking at probably increase rental rates just to be able to service and ancillary uses to support Amazon, as well as increase pressure on land prices. So I see opportunity and growth in that area. But what I also see is other type of product types that we didn't really get to address in the presentation with respect to storage facilities that offer a bit of a diversity for investors, as well as good stable growth, and as well as data centers. And I think that those areas are going to grow a little bit more. So from a product standpoint, you're looking at probably industrial, good opportunity in sustained return in apartment diversity with data centers and storage, and as well as the life sciences center as product type. But geographically, I like the East End for potential growth and over the next few years.
Thank you, Ray. Just to add to that, I mean, you mentioned Amazon, but wasn't Amazon's project put on hold for right now because of wetland issues in the East End?
Yeah, and you had to bring that up. Yeah, I was thinking about my comments when I saw that in the news. With Amazon, there are some challenges there, but there's also other sites and opportunities, and it's being able to secure that large tract of land. So it'll be interesting to see what their next move is, because the newer product, you're looking at multi-story industrial. So to a certain extent, Amazon's one of those companies. It's a bit of a stretch with them going into the East End, but you look at the growth in residential development, you look at from affordability standpoint, and you see more people to work out there. So the East End never really were able to support that, and Amazon needs people to get to their warehouses. So I think this is a bit of a setback for them, but I think that eventually they're going to find another sort of location to meet those needs. But the challenge is that it requires quite a bit of land to be able to service, especially their newer warehouses. So I see that as a bit of a bump. I still see continued growth in the East End.
And really valid points. And I think you're absolutely right. There's still probably other locations, and I'm sure that those regions are also looking for other locations for Amazon and other players to come out. With that in mind, do you think the values will fall with higher anticipated vacancy rates for office and retail?
It's going to be interesting to watch, because with some of the office transactions that we've seen in actually the past couple of years, it's been potential redevelopment opportunities, and some of the office, especially the older office buildings, have outlived its current cycle as an office. So potential use as residential or condominiums. And because of those type of opportunities, some of the prices that we've seen for the transaction of these properties, because of the potential opportunity down the road, they've had higher prices than we anticipated. At this point, I don't think there's any of the owners that are in a situation whereby they're forced to sell at a lower price unless they have to. And there may be a few private players in that situation, but especially with the office buildings downtown, they're owned by institutions with long-term objectives that realize that there will be some bumps in the road, but they're in there for the long term and more anticipated growth. And that's why they're investing more into amenities and getting the buildings up to a certain standard. But again, I think for certain properties that we may see some price fallout in perhaps in the lower class buildings, but definitely with the A and certain B, that if anything, prices will be flat. But I don't see a big discount, especially with regards to the office sector.
Thank you. I appreciate that, Ray. Of course, the next question is going to Jason. I know you've been quietly waiting there, but given that medium and long-term rates are trending up, do you think that the Bank of Canada will rethink the current stance on the overnight rate?
Yeah, I mean, I think it's a question that's becoming, more and more common. While, I mean, they kind of stepped out of their comfort zone. The bank did when they started giving a little bit more forward insight in terms of what they're planning with regard to the target rate. I think they're, if we think about the other side of what we do at TRREB, in terms of the housing market, I mean, I think there certainly are concerns around affordability and the pace of price growth that we've seen, and that oftentimes finds its way into the realm of public policy, and so it'll be interesting to see. I think when you look at the pretty rapid uptick in bond yields, we looked at the 5 and the 10-year bond earlier on during my presentation. I think to a certain degree, some bond market participants may be anticipating the Bank of Canada acting a little bit sooner, but there's a flip side to that argument as well, because the Bank of Canada's decision goes beyond just one sector of the economy, and so if you don't just look at housing in a vacuum, let's think about a lot of those small businesses that both Ray and I talked about throughout our presentation. So thinking about the hospitality industry, thinking about bricks and mortar retail. I mean, a lot of these businesses were quite literally just hanging on by a thread and continue to do so up to today. And so thinking about them, getting back on their feet later this year and into 2022, part of what will sustain their business and allow them to survive while they're getting back on their feet is taking advantage of very low borrowing costs, especially thinking about, interest only, line of credit type products that would allow them to, it gives them some time or more time as they sort of recoup their losses that they experienced over the past year. And so, I think, to a great degree, I don't envy the position of the governor of the Bank of Canada, because on the one side, we have a housing market that's very tight. A lot of that to do with, still not seeing a lot of movement on the supply front, yet a very rapid rebound from what we saw last spring. But on the other side, you have a lot of smaller businesses in those sectors that haven't recovered, that are going to need all the help they can get, and certainly low borrowing costs would help with that. And so, I think the jury's still out to a certain degree, and I think a lot of their decision may depend on what we may or may not see in terms of policy on the housing side outside of monetary policy.
Oh, lots to consider, and lots of sectors to think about in that with that answer there. Jason, are you ready for this one?
I'm ready.
Okay. Do you think, or it looks like cap rates are remaining very low for multi-residential, and you mentioned that population growth will reinvigorate rental demand. How will the rental market unfold over the next year? Thinking about purpose-built rentals versus investor-owned condos.
Yeah, I think it's a really interesting point. I mean, I think if you juxtapose, what we saw in terms of the vacancy rate, both for purpose-built and for condos, I mean, we saw a big jump in both cases when we look at the CMHC report that came out for their 2020 end of year 2020 survey. You juxtapose that against, where cap rates are from Ray's presentation. I think, by and large, the market's outlook for multi-res is quite strong, and I think that makes a lot of sense because, in a year where, we basically didn't see any population growth and we actually saw a net decline in terms of non-permanent migrants, students and temporary workers and what have you. And really from an historic perspective, the vacancy rate, didn't get that high. And so, when we start to see record levels of immigration and we start to see non-permanent migration pick up again on net, if not in the second half of this year, then certainly 2022, that's going to put a lot of pressure on the available rental space that exists right now, because it's not like, over the last year we've seen a real uptick in purpose-built rental construction. And add to that, you look at the investor-held condominium apartment units. Well, a lot of those have been listed for sale. And so, you have to think that longer term, we might be in a tighter rental market situation than, say, what we were in 2018 and 2019 once population growth resumes. And so, I buy into the trend that we're seeing for cap rates right now in the multi-res market, that they're continuing on, the downward trend, because I think long term, you're going to continue to see growth there. I don't know if Ray might have a comment on multi-res as well.
Well, I totally agree with you, Jason, that we're still seeing cap rates, even though the activity fell off 2019 versus 2020. And again, I think that's because of the lack of products, especially with investors wanting to let go of those type of assets. And for anything with a redevelopment potential or expansion for on the multi-res side, we're seeing sub 3, sub 2.5 cap rates, because the anticipation of further revenue based on the redevelopment or expansion of the property for revenue rental growth. So I think everyone needs a place to live, and based on the current vacancy rates on the apartment sector, it's gone up a little bit, but again, it's still very low, especially when you compare to some of the U.S. markets, and anticipate that cap rates, especially for that asset type, will remain really low. And we're going to be surprised this year with I think a few transactions probably going sub 2% in the GTA.
Thank you. Well, you heard it from both of them. So I've got one more question for each of you. So get ready for this. All right, we're going to do some tough ones. I know I said that about the last ones before, but Ray, you touched on this in your presentation, and you had mentioned about, the hybrid model of people and going back into the workforce and into office spaces. So my question to you is, do you think we will return to the office? And if yes, what will it take to get people back into the office?
I'm a big proponent of getting back in the office. I miss that interaction with my colleagues and be able to have one accidental discussion by bumping into people in the hallways. And I think that's how ideas are created. At the same time, I think that there's a shift on preferences on how people are balancing work and their personal or family lives with this hybrid model. But to get people back in, especially the vaccine's going to play a big part of it, just because people want to feel safe of getting back on public transit and feeling safe once they get back in the office with a certain amount of social distancing. And you're looking at especially with the landlords now, that they're talking about the increased air circulation, the better circulation, the increased investment in filters to allow for better and sort of safer air circulation within the premises. But from amenities, it's going to be focused on wellness, a reason for people to come back into the office and feel safe at the same time. And there's going to be a lot more sort of automation, I think, especially with the premises in the way of climate control, and as well as allowing for certain controls and that the tenants and the companies can control, and as well as resulting in some more efficiencies from an owner standpoint. So I think we boil it down to getting people back in the office is creating a workspace that is conducive for more collaboration and discussion, but as well as adhering to certain safety measures for them to feel safe, as well as giving them a reason to come back into the office for everything that we just mentioned, especially with the collaboration and synergies, and not just coming back in the office just to do work, but there has to be a reason to drive them back into the office place.
And just to add to that, I mean, in your presentation, you mentioned about, going back into the office space in more of a either later 2022, 2023. Do you still see that happening?
Well, again, the challenge right now is what's going to happen in the next 6 to 9 months. And almost every week that we're going to receive X numbers of vaccine, and then the week later or next day it's going to be less than anticipated delivered. So it'll be interesting with the rollout and to see the percentage of the population that gets vaccinated. But even when everyone gets vaccinated, I think there's going to be a bit of a delay for people to feel comfortable again. So I'm trying to factor in that delay with the percentage of people going back. So right now, it's not a surprise, but the amount of people going back in the office downtown is relatively minimal. But I think that's going to pick up. And I think it's going to pick up end of this year and going into next year, depending on the vaccine. And I think it's going to take some time for people to work out their office strategies and as well as the office design to accommodate that. So I think it's going to take a little bit longer for us to go through this whole transition. Like a year ago, it was a lot easier that, okay, everyone needs to work from home, but this adjustment of getting back in is going to take a little bit longer than what happened a year ago of everyone just shifting back to the office. It's just going to be a lot more other factors in play.
You know what, and you brought up a valid point, and I hope that, companies out there also consider the human condition part of it too, right? It's a mental game changer too.
Exactly.
From working from home to, or even that hybrid model of a couple of days in the office, couple of days out, and readjusting our lives, and parents and all of those things, and have to be taken into consideration. I know we had a discussion with the Board of Trade about this, and the adjustment period of just the human conditioning of transitioning back into, getting back onto the road at 4 a.m. or 5 a.m. or whatever it was, right? All of those factors really do need to be considered. So I appreciate that. Thank you, Ray. And Jason, so a lot of commercial retail sales through TRREB are smaller retail space. And some of those sales are businesses. Given the changing retail environment, what do you think the outlook is for the sub-segment of the commercial market?
Yeah, I think it's interesting, and it gets back to what we were talking about a little bit earlier as well around interest rates and what the Bank of Canada is going to do, because if the conditions are there that a lot of these sort of smaller mom and pop shops, if you will, are able to stay afloat and take advantage of low borrowing costs and accommodative lines of credit and keep running their business, I think there is a groundswell of support now, I think, for local businesses throughout the GTA, and I think that would continue as we move into the recovery phase, because quite simply, I think a lot of people are going to want to visit the bricks and mortar store and have that more traditional, I guess, social interaction that's been missing so much over the past year. I guess the flip side to that argument as well is that if we do see higher vacancy rates for some of these sort of retail strips, especially along say avenues within the city of Toronto, we are seeing more and more sort of mid-rise types of residential developments coming into play, and I'm thinking of Yonge Street Avenue corridor and other corridors that will exist along what are rapidly building up transit ways, that there is the potential that we see some of this sort of traditional smaller retail space also convert into more sort of mid-density or mid-rise residential development with a different flavor, I guess, of retail at street level, where you'd be going after larger tenants. So I think there'll be a mix. I think and I'm very hopeful that a lot of sort of smaller entrepreneurial mom and pop type of establishments remain in business, and they get the community support that they deserve. And I think that will happen to a great degree. But I think at the same time, we were already starting to see, more sort of avenue, mid-rise, type of development that incorporated sort of larger scale, tenants along major thoroughfares. And so I think, that'll come into play or continue to be in play for in terms of sort of turning over some of this traditional retail moving forward. And Ray may have something to add, because obviously Altus covers both sides of the market. They cover the new home development side as well as the retail side as well.
Yeah, and what you just stated, Jason, with the smaller transactions, that's what was driving the retail activity last year. It was a smaller transaction with the private players. Again, looking at some of the opportunities for redevelopment. So probably we'll see some other sort of possible mixed uses with the residential and the retail. And again, it was all about survivability with the retailers over the past year, whether or not they can hang on, and they have been sort of leveraging the government subsidies, and it'll be interesting to see how this goes forward with those positive growth rates and sort of that the large savings people have, whether or not that gets redeployed in the market. But that growth for people, I still believe that there's still big demand for the urban area, especially with amenities and walkability, and for people to live within walking distance of commercial and retail. Right. And I think that's going to spur that growth going forward. So I think that's going to be a positive outturn with, especially with the activity that we've seen on the retail side with sales transactions in the past year.
So there you have it. Lots of flavors to look out for, and stay tuned to watch out in the coming year. And of course, I have to say thank you, Jason and Ray. Absolutely fabulous presentation, and for taking all of these questions. And hopefully we do get to see you in person again one day, as on that note, because we do all miss that as well. So again, once again, thank you, Jason, Ray. Thank you for your thoughtful, provoking presentation, and for answering several questions. And if there is additional questions, please send them in. We're happy to answer those. And don't forget to visit TRREB.ca to visit the latest commercial market watch reports. And thank you, everyone, for joining us today. Take care.
Thanks very much.
Thank you.